At this time, I would like to hand the conference over to Mrs. Samyak Jain of 4S Services. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of 4S Services, I welcome all the participants to the Apar Industries Q3FY21 earnings conference call. Today on the conference, we have Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Devakar, CFO of Apar Industries. I will now like to hand over the call to Mr. Desai for his opening remarks. Over to you, sir.
Yeah, thank you. Good afternoon, everyone, and a very warm welcome to our Q3 FY21 earnings call for Apar Industries. I will start the call with a quick industry update and then an overview of our performance, followed by more detailed information on the segmental performance. Post all this, we'll open up the floor to questions. So at this stage, we're happy to report a good performance despite continued adverse sentiments in Q3, especially the difficulties that have been faced in the domestic market, where there is still some pandemic firefighting mode going on. Apar's diversified portfolio of products, customers, and geographies helped us with a relatively strong response to the situation. Our profit has grown substantially. It's 2.5 times what it was on a consolidated basis compared to the third quarter of the previous year, with a large contribution of this coming from our specialty oil segment. We continue to have a focus on exports, look at certain niche markets like agriculture loops, which actually has paid significant dividends through this period, maintained a strict focus on our per order profitability, and we've tightened credit terms besides looking at various initiatives to reduce cost and improve productivity. The domestic market continued to see headwinds for the state transmission and distribution projects, as a lot of state funding was channelized towards the pandemic response. As a consequence, a lot of tenders were postponed. There is now an improvement in the order booking for both conductors and cables, and we expect the situation to continually improve going forward. In Q3 FY21, Apar posted a consolidated revenue of 1,699 crores, which is 7% lower than the same period previous year. Our exports, however, were up by 6%. The domestic revenues were down by about 7%. The EBITDA at 163 crores is 37% higher than in the previous period and stands at 9.6%, which is an expansion of 312 basis points. Our finance cost has come down by 57% year on year due to favorable LIBOR and local rates, as well as reduction in the number of days of working capital that is being utilized. This excludes a one-time charge of 14 crores related to some IGST related expenses. So PAT adjusted after this one-time charge came in at 93 crores, which is 5.5%, and it's 347 basis points higher than the same period previous year. In the 9-month period for FY21, Apar has posted consolidated revenues of 4,491 crores with an EBITDA of 316 crores and a profit after tax of 123 crores, which is 10% higher than year on year. This is we consider this to be good, as the company had to tide over obviously the first quarter where there was relatively very little production and sales that took place. I would also like to cover a few industry highlights and touch upon some of the happenings in the budget of 21-22. So in this budget, there is an outlay of 3,05,984 crores which has been announced to be spent over the next 5 years for launching a revamp and reforms which are result linked in the power distribution segment. This, coupled with 1.2 lakh crore liquidity package under the Atmanirbhar Bharat program, which was announced in May of 2020, augurs well for the sector. BRISIL estimates this to be about double the incremental debt requirement of the DISCOMs in FY20 through to 23. We are still awaiting more details on the same because some of these have riders and with respect to what the state government needs to do. But overall, this should be a major shot in the arm for the sector and something that we've all been waiting for a while. Also, there is a 60% increase in allocation towards renewable energy for FY22, which stands at 5,753 crores. The budget has also given a major boost to the railway electrification, telecom infrastructure, automobile and EV industry, which is good for the portfolio of products which we have. The government plans railway electrification to reach 46,000 railway kilometers by the end of 2021. The allocation to BharatNet is at 7,000 crores, which is up 27% from the FY21 estimates. Allocation to the fiber optic cable database network for defense services is also up by 30% to 5,200 crores. FAME India, which is the scheme for electric vehicles, is also allocated 757 crores, which is up 138% year on year compared to what was in FY21. Through the pandemic so far, we have seen that the production of railway locomotives and coaches has been at a very, very low level. Our expectation is that from the fourth quarter of FY21 onwards, there will be an accelerated production to catch up for missed time, and this will augur well for our E-beam cables that are produced both for locomotives as well as coaches. Key transmission and development companies have received orders of about 8,600 crores in this quarter so far. As per the government's year-end review, 83 new substations were commissioned, 224 substations augmented, and 27,261 distribution transformers installed from April to November 2020 despite the lockdown. Loans worth 43,000 crores were disbursed and released, and 1,18,508 crores sanctioned against the liquidity infusion package announced by the government. 8,439 circuit kilometers of transmission lines were added in the period April to November, which is up 19% year-on-year basis. So this seems to have cleared a reasonable amount of the backlog of inventory which was being held through the pandemic. So our expectation is that offtakes will start increasing as we move through the coming quarters. I will now like to just go over the performance on a segment-by-segment basis. So in the conductor business, the revenue has declined 15% year-on-year and come in at 737 crores. This was mainly due to a 28% decline in the domestic revenues. Demand for conventional and HEC products was subdued in the domestic market, as I mentioned earlier, especially in terms of tender finalizations. Exports declined 6% year-on-year. We did have a setback where the export benefit under the MEIS was withdrawn by the government of India, and that has had an impact in terms of our realizations in Q3. The scheme now stands closed, and a new scheme has been announced by the government, but that does not carry significant benefit. Total volumes fell 13% to 31,671 metric tons. Amongst the higher value products, our HEC, high efficiency conductors, contributed 15% to the revenues, and copper conductors contributed towards 11% of the revenues. The rod business increased by 22% with a revenue share of about 14%. There has been an improvement in the offtake of our copper transpose conductors which go into the transformer industry, where we have been gradually receiving more and more approvals. And there has also been a better order book that is coming for the OPGW projects. The EBITDA per metric ton post forex adjustments came in at 13,022 rupees, which is 5% higher on a year-on-year basis, mostly from cost discipline and some of the productivity initiatives that we had. In terms of a new order inflows in the quarter came in at 1,047 crores. That's up 68% year-on-year. and 30% more than in the previous quarter. The order inflow from railways for copper conductors was up 2 times that of Q3FY20 and contributed 46% of this new order flow. Export order inflows contributed 35%, and order book as on 31st December 2020 came in at 2,123 crores. So that's 25% higher than Q2FY21. The total amount of export share of this 2,123 crores is 55%. In the 9-month period, the conductor revenue came in at 2,075 crores, which is down 26% year-on-year. The EBITDA forex adjustment per metric ton, after adjustment per metric ton, came in at 10,357. So that's 3% lower than on a year-on-year basis. The new order inflow during this 9-month period was 2,169 crores. Coming to the specialty oil business, here the revenues have increased 18% year-on-year to come in at 692 crores. We had a 30% increase in the export revenues during this period. This has been the highest Q3 sales volume that we have achieved in the last 4 years, with the sales volume closing in at 1,20,205 metric tons, which is up 18% year-on-year. The Hamria plant's capacity utilization was close to 99% in that quarter, up from 65% in Q3FY20. Our white oil sales increased by 25%. Transformer oil exports increased by 5%. However, we had a 7% drop in the transformer oil domestic business, which, as I mentioned earlier, was plagued by the lack of resources that the utilities had. So we've been maintaining a relatively low profile with respect to the transformer oil distribution segment. The industrial oil volumes have grown 19% year-on-year in this period. Automotive volumes for us have grown 31% year-on-year, both being contributed by the agriculture, the retail segment, as well as growth in our OEM accounts. So if you take the lubricants, which is industrial and automotive put together, it's up by 29% year-on-year, and today it contributes to 26% of the revenues of the division. The EBITDA per KL after forex adjustment increased to 165% year-on-year. So it came in at 8,158 rupees. The EBITDA improved significantly with improvement in prices as well as a product mix, i.e. the lubricant portion was higher compared to previous periods. In the 9-month period, the oil division posted revenues of 1,642 crores, which is 8% lower than on a year-on-year basis. The EBITDA per KL came in at 5,987 rupees per KL, which is 82% higher than the 9-month period previous year. Q4 FY21, however, has had some disruption of lube base oil supplies, mainly because of COVID-19 related issues. Given that there are lockdowns running in many parts of the world, the fuel demand has contracted, resulting in less feed going into the lube refineries, due to which there have been supply outages and a major strain with respect to the base oil supply chain. What has been happening for us is that as months have been passing by, our inventory levels have been falling, and therefore we could see some impact in the fourth quarter due to some supply chain outages. We are obviously working with various refineries with whom we have long-term contracts to try to speed up supplies to us, but this does remain somewhat of a risk. If you look at the cable side, the cable revenues were 18% lower year-on-year, came in at 322 crores, mainly due to overall low market demand and unremunerative prices from significant competition, given that demand was lower. Exports contributed 16% to revenues in Q3, up from 13% a year ago. The power cable side of the market continues to remain fairly competitive. The elasto and E-beam cables saw reduced demand coming from the railways and defense particularly, where, as I mentioned earlier, the production levels were very low. We are optimistic that over the next several quarters there will be some sort of a catch-up, as there will be pressure to make up for lost time. The solar sector also was relatively slow, but from December onwards we have started seeing an uptick in terms of orders for cables going into solar installations. The optical fiber and telecom cables also saw a relatively slow offtake from telecom companies. The EBITDA margin post forex adjustment came in at 8.4% for the quarter versus 10.6% for the same period previous year. If you look at the 9-month period, cables has posted a revenue of 826 crores, which is down 28% from a year ago. The EBITDA margin post forex adjustment came in at 5.5% versus 11.7% in the 9-month period. However, Q4FY21 has started with a good order inflow, especially from the solar and the wind segments, and with an expectation that call-ups will start taking place for railways as well as the defense. Going ahead, we expect recovery in the domestic demand to be very strong. We hope that the DISCOM reforms announced soon come about and the execution plans are well laid out. There is a clear buoyancy also in terms of demand from the export markets, as global energy transition is taking place towards renewables and is creating a demand for transmission lines and new distribution networks. So as mentioned in our call, our product profile is, we are continuing to focus on the higher value added items, and we are constantly focusing on improving the return on equity with a limited capex spend to come in the next few quarters. So with this, I'd like to end my comments. I thank all of you for joining us on this call, and would like to open up the floor for questions, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pratiksha Daftari from Equentis Investment. Please go ahead.
Good afternoon, sir. Thank you for the opportunity.
Good afternoon.
Okay, I wanted to ask, what kind of inventories do we keep for our raw materials, our base oil and metals, and what kind of impact do we see of rising prices on the profitability going ahead?
So the typical inventory which we carry for our base oils is about 30 days in tank, and generally you have another month which is on the waters coming in. So about 60 days is the gross inventory level. In the case of our conductors and cables business, also the inventory is approximately, if you take the total inventory, it sits at around 50 odd days.
Okay.
Now, there has been a steep increase in all commodities. So it's, there's an increase in terms of base oils as well as aluminum and copper, and particularly the most steep has been in the case of steel.
Right.
So our expectation is that in terms of the base oil side, we would be in a reasonably strong position to pass on those increases as things stand today, because the supply chain itself is very tight.
Okay.
So as a consequence, the whole industry is going to run on pretty tight inventories, and whatever they sell will be pretty current cost. So they have been, on the lubricant side, Castrol has already announced its second price increase in 2 months.
Okay.
They being the industry leader, normally, the rest of the industry follows suit. So to some extent, I think the whole, the oil side will have, a certain amount of cushion. We have had relatively higher margins in Q3. We don't expect the same high level of margins in Q4, but our margins should mean revert back, into the 4,500 rupees per KL sort of range, and we should be able to maintain that in, through the Q4 period.
Okay.
In terms of the conductor side, we have an exposure really on two fronts. One is the steel prices have gone up, where there is no hedge, and in fact they've gone up quite substantially. So that's where there will be some amount of hit. Also, wherever there are DDP and CFR contracts, particularly with government and semi-government utilities, there the freight cost is going to hit us, because there's been a substantial increase, in freight and shipping costs. And, these contracts don't have an escalation in freight. They have escalations in terms of, the raw material side, particularly aluminum and copper. We don't see a huge problem on the aluminum and copper side, because there we have price variations and we are pretty much hedged.
Okay. So how much of our, the contracts would be without any escalation cost clause for freight?
So, most of the export contracts which are there, wherever they are CFRs, they don't have, an escalation which is there for freight. So wherever you're supplying to private companies, you can sit and negotiate it. Wherever it's against tenders of World Bank and, some of these utility tenders, there will be an impact. So I don't have the exact percentage number available offhand.
Okay.
But there will be some impact, coming on that particular front.
All right. And so we've been, you've been mentioning that there has been focus on profitability for conductors in general, high order profitability. So I just wanted to understand how much of this is coming at the cost of volume growth, or, if we had to maintain our profitability, what kind of volume growth can we expect?
What we've done is actually got into other related conductor businesses. So the conventional conductor business may remain stagnant, but the other newer products like the HEC, then the copper for the railways, then OPGW, then the CTC for transformers. So these are new segments that we have created. So these businesses we have invested in, and they are sort of at different phases in their growth right now.
Okay.
So OPGW actually is quite an interesting situation, because it was largely being serviced by imports, if you took it as 4 or 5 years ago. There is a Chinese company that has set up a large capacity, and today under the new norms, they have difficulty in quoting for new business.
Okay.
Pretty much left to, 3 players. It's become a 3-player market, and the volume, is likely to increase over the next few years. So OPGW is something that will grow. Copper transposed conductors, as I mentioned in the opening remarks, we're getting more and more approvals from utilities and transformer OEMs. So that product line also will grow. The railways have, after a gap, have finalized contracts in the last couple of months only. So we received an order in excess of 450 crores, which I had mentioned during the opening remarks.
Right.
So all those segments are, showing signs of growth. So, as we get into FY22 and 23, we see that, there is a tailwind in all these segments. Also, high efficiency conductor, the transmission companies today, based on our latest discussions, are that their cash flows also have improved, and allocations are, they are being allowed to now start finalizing the tenders and going ahead with the implementation of projects that they had lined up. So you will see the HEC side also as we get into FY22, ordering and execution starting to improve.
Right.
So we'll just allow the conventional conductor thing to fall, as the capacities of all these other things utilization goes up.
Fair. Okay. And what kind of execution period do we have for this 2,000 crores order book? And do we have a pipeline right now that we are working on both conductors and cables?
Execution period is about 8 months actually for the pending orders, and the pipeline is 301 crore.
Pipeline is
301 crore. 301 crore pipeline is there.
Okay. All right. And if you could, if I, adjust for the one-time finance cost of 14 crores, we are seeing a sharp decrease in finance cost for the quarter, which is commendable. I just wanted to understand, do we see this, sustainable, and what are the key factors? Like, how much is it because of LIBOR and how much because our days have come down?
At present, I will say it is mainly on account of LIBOR and the local interest cost coming down. But we have taken a lot of action as far as number of days are concerned, and those things are going to materialize in next 2-3 quarters. Actually, it takes time to adjust those things.
Right. And if you could just give me the total outstanding LC amount.
Yes, I'll get you. The total LC is 1179 crore. Out of that, 827 is LIBOR based and 352 is domestic.
Okay. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1. The next question is from the line of Saurabh Patwa from HDFC Mutual Fund. Please go ahead.
Good afternoon, sir.
Yeah, good afternoon, sir.
Hi. Thanks for taking my question, and congratulations for a really good performance in these difficult times. So just wanted to have your thoughts on a very slightly longer kind of a period compared to the past. So I think last 3-4 years, what has happened is we have actually performed really well in terms of EBITDA, in line with broadly what we had been communicating to through these calls. But so I think our CAGR on last 3-year basis, our EBITDA, I'm not taking FY21 into account, this being an aberration kind of a year. So even in FY20, despite last quarter's disruption, our EBITDA grew 30% on absolute basis on a 3-year basis. But by the time we come to PBT, actually the numbers look like it looks like we have actually degrown. So, and I think largely the reason is actually the depreciation which has increased and also the finance charges. And this is despite the fact that our debt has actually come down. I guess you guys have already communicated in your calls in the past, which is because of the LC-based funding and bank charges, etc. But so, what would be the key driver of EBITDA converting to PBT going ahead? So I think our LC-based funding itself has started coming down. So from maybe I think it was I think in FY19 it peaked I think around like 3,200 crores, and now it is, as you mentioned, it is close to just 1,200 crores. So I think that there has been significant headroom done there. But what's your thought there, sir? And in terms of depreciation also. So as you mentioned that I think large part of capex was done on this conventional conductors and all new value-added products, but part of it we already started gaining in terms of EBITDA, but I guess it was not enough to get transferred to PBT. So just how, like maybe 3 years, 2 years down the line, how you think the performance should look?
So our sense is that, first of all, there will be a period where in the next maybe three years, the horizon you're looking at, where you will see a low interest rate regime. So there is a definite benefit that we have in terms of, lower interest rates, which will translate, to the bottom line in terms of, and we've already seen that in the last quarter, which is more representative because, collections and things have now come in line.
Right.
So the first half was a little disrupted because of COVID. But then when you look at particularly Q3, it's more representative of the type of, interest that we will be picking up. So in the EBITDA, the two big pieces are the interest and the depreciation.
Right.
On the depreciation side, we don't have significant capex going forward. There's only capex which will be largely for productivity, quality, some debottlenecking, etc. The big chunk of capex is already through, and as our value-added products start growing, you'll also see the EBITDA also growing on a per unit basis, whether it is per ton for conductors or whether it is on a per KL basis for our oil business. Because as I mentioned earlier, the lubricant business also has grown,
right,
and that actually carries a higher per KL EBITDA margin also. So you'll find that the EBITDA percentage itself should grow, plus the absolute value of EBITDA will also grow. The interest and depreciation will kind of remain depreciation will remain constant in absolute terms, and interest will be at whatever level you are seeing pretty much in the third quarter of this year. So I would see a significantly higher translation of EBITDA coming into PBT. And as our Hamriyah facility starts cranking up, and more and more approvals have been coming through during the last 9-month period, so we are able to grow larger volumes there, even though the region has been a bit subdued. And whatever profitability comes there, it is free of tax, so it helps go straight to the bottom line. So you will see profitability growing, and our whole focus is on return on equity. So you will start seeing the return on equity also improving, year on year.
So just one small thing, whether I'm not sure whether you'll be able to do it right now. Can you share a number like what at the peak capacities which we have right now? We're not giving into detail, but like broadly, if we are at like maybe 90% of our capacity in conductor or 90% of capacity in transformer and specialty oil, what kind of revenue and EBITDA can we have based on current numbers?
It will depend upon the mix actually. At present, the capacity utilization in conductor is 72%. And the oil also is around 72%, and the cable is 55%. But this 72%, all the new product lines which we are added in conductor, like OPGW is only 2% at present. CTC is also only 2%. So these new product lines are just beginning to.
So that is what I'm trying to understand, sir. So when you so whatever capacity of OPGW we have, of whatever capacity of.
We'll give you offline actually.
Okay, I'll get in touch with you, sir.
Yes.
Okay.
Yes.
Okay, sir. And so just one last question from my end. When we say this Hamriyah has reached 99%, is this if you can just help us with, there would be some amount of, historically when we started Hamriyah, a large part of export order which we were supplying from India were moved there. So if on a like to like, say, what would have Hamriyah gained itself, like say like when X of orders which were moved from India? Can you share that kind of a number?
So, that would be kind of slicing it a bit too fine, but generally what's happened is that there was a certain customers obviously moved from India over there because the servicing was much
easier
and more efficient.
Right.
But our share of business in that region has substantially grown. So if you see the amount of export of transformer oil going from India into GCC, we have 80% market share today.
Okay.
So some of our competitors who are also having significant sales into the GCC, we've pretty much knocked them out because of logistics and the speed of delivery. And today with the freight costs having gone up, the domestic freight costs haven't really increased very much. The tanker freights, as much as the container freights. So we've gained share of business and market share within the GCC. We've also added new customers. So I'd imagine that at least about 30-40% of the business is from new sets of customers.
Okay.
And there is a share of business growth also which is there.
Right.
The nameplate capacity that we set up was 100,000 KL, which is about 8,250 KL a month. But, if the business goes up, then we need to look at debottlenecking, some drumming capacity and things like that. The core capacity can increase substantially more than the 100,000.
Understood, sir.
So, I don't really see huge investment going in to keep debottlenecking, what happens at Hamria.
Fair enough.
And because the plant is very automated, it has a big leverage in terms of cost.
Yeah.
So as your volume throughput goes up over there, the cost basis increases very marginally.
I think that is what we can see this quarter when this Hamria reached 99. I think our EBITDA to PBT transfer has been pretty high because the
exactly. So that is so depending on the loading at that plant,
yeah,
because of the automation, as you keep loading it more and more, the incremental cost is relatively marginal. It's lower than what would be the incremental cost in India to service the extra business.
Right. Thanks a lot, sir. And
Yeah.
all the best.
Thank you.
Yeah.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Viral Shah from Prabhudas Lilladher. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon, Viral.
Sir, harping on the question of conductor margins as well again, we had a steep increase in prices. Does that mean that this 13,000 rupees per metric ton EBITDA will come down by maybe 10% odd for 4Q, or that guidance is not possible?
So, to nail an exact number is a little difficult because there are a bunch of moving parts, especially with respect to freight. It's something which is changing on a day-to-day basis simply because of the physical movement of goods under, these COVID-related conditions. So, the freight portion is a little unpredictable in this coming quarter. So, it's difficult to nail a number. Our sense is that as you get into the May-June time frame, you'll start seeing, with the vaccine program and with, the spring and summer coming in, demand will start improving and there'll be a more normalization of movement of goods taking place.
Agreed. Sir, also we look at that 9 months just before pre-COVID, when we had, met you. Our strategy was very clear that we would be focusing on export because we were looking at great demand coming in all the 2 segments, in fact all the 3 segments what we are into from export market. But now since the budget, when you see that there is huge amount of opportunity in domestic as well, so has our strategy changed or still we continue to retain both export and domestic equally?
So we will continue to look at both the segments because there are certain geographies where there is a good demand which is there for export. So for example, if you look at conventional conductors, our sense is that we will get better realization for conventional conductors in export than we will get in the domestic market simply because the competitive environment is a bit different.
Yeah.
However, for some of these value-added products, which is your high-efficiency conductors and, railway conductors and all, obviously we will be focusing much more on the domestic market. So depending on the product line, we will maintain our presence in both export and domestic, but I think the overall mix will start looking much richer, much better. Because you'll be able to optimize, for each category of product, which geography you're looking at selling. Fundamentally, I think the Indian side or the domestic side, the fundamental demand itself will grow. And we have the capacities in place to actually service this.
Yeah, fair enough, sir. So second and last 2 questions from my end. In terms of working capital, have we started receiving payments on time from private players and government? What is the stand there onto it? And lastly, on cables, we did mention that you expect a good amount of ramp up happening in defense and railways. Are we having the highest number of market share in that segment, and what's the outlook there? Thank you.
Okay, so payments have definitely improved as we've gone month by month. In fact, they're now pretty much at normal levels. So we don't really see any major problem, in terms of collections. So that's the first part of the question. What is it?
Yeah. So if I may add, some of the working capital has also been tied up in our case because we are doing certain project work. So some of the COVID-related restrictions did not allow us to do the project work, and then there was some more money blocked in the form of retention monies, So those things also in due course will get unlocked.
Yeah, sir. Got it.
So the working capital side actually has improved, and if you look at it, first quarter versus second quarter versus third quarter, it's getting better, and the fourth quarter should be better than the third quarter. So so that side is looking fine. Can you just repeat the second part of your question?
Yeah, second part of the question was on the cable division.
So on the cable side, we definitely expect that from Q4, because there were some serious problems with the production facilities of the railways and the defence, because there would be a couple of COVID cases and the whole shop floor would be shut down, and these are pretty large shop floors. So now the cases have obviously come down significantly, and there is a lot of pressure to complete some of this work, and we don't have the most friendly neighbors sitting around. So as a consequence, the pressure is coming on the defence side. As far as railways is concerned, there is an outlay increase, and as a consequence, the future requirements are further going up. So you not only have to catch up on backlog, but also meet the future requirements. So our sense is that over the next 4 to 6 quarters, you'll see a very steep increase in terms of the locos coming out and the coaches coming out.
Fair enough, sir. Sir, lastly, in terms of market share, because in defense and railways, what will be our market share be? Because we understand that E-beam and electromagnetic, we would be one of the largest player in this segment, or not?
So we have a significant share in that segment, and in fact we were just putting up our third electron beam is just getting commissioned. It got delayed because we couldn't get any of the foreign engineers to come in, so we've commissioned it pretty much ourselves through remote monitoring from the supplier. But there is increased competition in that area because other players are also coming in, but we see the absolute volume of the business also growing. So in addition to cables, we've also entered the harness business for locomotives and coaches. So now today we are participating in a harness tender with our own cable, plus supplying cables to the railways directly and to other harness manufacturers. So our sense is that, even though competition will increase with new players coming in, because the market is going to grow, and because now we are participating in both harnesses as well as supply of cables, we should be able to maintain our share.
Fair enough, sir. So lastly, if I may add one, what is the capex for FY21 guidance, and how much we have incurred for first 9 months?
We have incurred capex of 30 crores in the first 9 months. And there is not going to be much capex in future actually, as far as next year is concerned.
So capex will be pretty much within the depreciation, that we are looking at. It's not it's not going to make a big difference in terms of, the total working as such.
Fair enough, sir. Sir, got it. Thank you so much, and all the best for you.
Okay, right. Thanks.
Thank you. Reminder to the participants, to ask a question, you may press star and 1. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Sriram Rajaram from Ratnatraya Capital. Please go ahead.
So thanks for the opportunity. So just want to know, at full capacity, what can be the potential revenue for these for conductors and cable business?
Full capacity, almost 5,000 crores for conductor we can achieve.
Okay.
Keeping in mind the, copper in price.
Cable can be 2,200 crores.
Cable would be how much, sir?
2,200 crores.
2,200 crores. Okay. And what would be the incremental CapEx that is required? I mean, probably after a couple of years.
So, as I mentioned earlier, that for the next couple years, whatever capex goes in will fundamentally go for some debottlenecking and productivity programs, maybe some quality control equipment and things like that. So it should come within the depreciation that we have.
Okay.
So you say also clearly you will see free cash flow coming out, from the businesses.
Okay. And so just one more question on the cables front. Can you give the breakup for the which are the segments in the cable, like solar, wind, e-beam? If you can throw some light on that, would be like.
You want the percentage actually?
Yeah, percentage would do, sir.
Percentage, Elastomer is 27%.
Okay.
OFC is 12%.
How much? Sorry?
12% OFC. 12 LP.
Okay, 12%. Okay.
Balance is XLP, 61.
Okay. Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Nimish Shah from MK Investment Managers. Please go ahead.
Yeah, thanks for this opportunity and congratulations for a very good set of numbers. So I just wanted to understand a bit on the opportunity for us in the cables and the conductors business on the export front. So we've been reading that Europe is, planning to add a lot of wind energy, windmills and wind energy. There's a huge expansion plan that has been going around. So do we see that as an opportunity for us? So just wanted to understand on that one.
Yes, so actually the opportunity is clearly there. In Europe, another geography where we have already got traction and new business coming in is from Australia. And Australia is also, as we mentioned in the previous calls, they have mandated significant switchover to wind and solar. So we see growth coming from these two places, also from Latin America, Central America, and we would expect that under the democratic government, the United States also will start spending more on infrastructure, which is something that was required to be done in the US, but during the entire period of the presidency of Donald Trump, there was not much investment going on in terms of, some of the aging electrical networks and things that they have. So that's one of the reasons why we want to continue to look at the export side of the business.
Right. And so these capacity additions and these investments should bode well for both our conductor and the cable business, right?
Yes, because what happens is that you need to build a new transmission network to evacuate power from these locations, which are different than where the current power plants are located. So there is a transmission network required, plus there is then cabling required, towards the last mile, as well as within the installations which are there. In addition to this, mass transportation also is a major segment. So for example, Sydney and Melbourne are expanding their railway networks in a big way. Just like in India, there is a significant investment which will go into the metro. And, we are supplying cables to the metro side. So the overall infrastructure investment, looks like, across the world will increase over the next 3 years.
Understood. Just one another data point. If you could help us with, thanks for first of all sharing the additional data in terms of the lubricants. So this auto and the industrial lubricants. Can you also, if possible, share what will be the EBITDA per liter in that segment for us?
That we are not giving actually. We are not giving only gas. We are giving for specialty oil as a whole.
Okay, no problem. Yeah. That's it from my side. Thank you and all the best.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. The next question is from the line of Aditya from Vibrant Securities. Please go ahead.
Not sure if you have shared the details of the interest-bearing liabilities, debt and supplies credit. Have you shared that number?
The long-term borrowing is 197 crore.
197.
197 is long-term. Short-term is 185 crore. And cash on the balance sheet is 241 crores.
241.
And the LC liability already I had shared actually, if you had noted down. If not, then I can give you again. So LC liability is... you noticed that.
Sorry.
Hello?
Yes, sir.
Should I share that?
Yeah, please share that. I missed that part.
Okay. LC liability is 1179 crore total.
Okay.
Out of that, 827 crore is labor based and 354 crore is domestic.
Okay. Got it, sir. Got it. And so going forward, what is your outlook on the interest cost? Because if you adjust for that one time, then it goes below 30 odd crores. So how should we look at this number going forward?
This number, if the turnover increases, then there will be proportionate increase in this number actually. Turnover increases either on account of the commodity prices or on account of the volumes, then there will be increase in this number actually.
Okay. However, in this quarter, even if you look at quarter-on-quarter basis, I think we have gone down, although revenues has gone up.
But we feel that for next 3 years, as Mr. Kushal Desai has said, actually, the interest rates will be soft only.
For next 3 years?
Next 3 years. That is what our estimate is there.
Okay.
Plus, the whatever actions we are taking as far as reducing the number of days, that should also help us in reducing the interest cost.
And do you mind sharing the working capital position, that is inventory, receivable and payable?
I'll share.
Yeah.
So, conductor data is 135 actually. This is 5-point average. This is not 1 point actually. 5-point average. 135 days. Inventory is 54 days.
Yeah.
Oil debtors is 78 days. Inventory is 51 days. Cables debtors is 114 days. Inventory is 77 days.
So conductors you said 135 and 54. I
135 and 54.
Okay. Got it, sir. Got it. Sure.
Thank you.
Thank you. Participants, to ask a question may press star and one. The next question is from the line of Nagaraj Chandrasekhar from Labrinum. Please go ahead.
Hi, congrats on a very good quarter. I had a few questions on the oil's margins. I guess part of, as you mentioned with the base oil price hike, part of this 8,100 per kiloliter margin is the mark-to-market of the base oils that we have at the end of the quarter, and part of it is the pure margin, which would have gone up because of Hamria and the increased industrial and auto lubricants in the mix. So could you give me a sense of how much that mark-to-market contributed to the margin per liter? And also, we know the annual figures for the Hamria, the revenue and the profitability when it was running in FY20 at 65%. At 100% sort of utilization or close to 100%, what sort of revenue and margin does Hamriyah do at PBT level?
We are not giving breakup between Hamriyah and India operations. But I am not clear on the mark-to-market of base oil.
So, Devaka, let me try to answer that. So, it's difficult to draw a very clean line because, it's like a moving book, right? But what we envisage is that in the fourth quarter, we will see the EBITDA per KL, reverting back into the 4,500 range. So that's assuming that this is the kind of clean operating margin that you would have without any benefits that accrue of cheaper raw material, etc., etc. Because there will be a certain amount of, you will have cheaper raw material coming in, but there will be some amount of leakage that happens as costs increase and you get an increase from your customers. There's always a lag, that exists for that. Our sense is that we'll be able to pass it through and the lag will not be very significant, but there will be some leakage. So, considering all that, fourth quarter number will be somewhere in the range of 4,500 per KL. In terms of the Hamriyah side, there are two pieces to it. One is that there is a more favorable margin regime, plus there is an operating leverage as the capacities have gone up over there. So, just generally I can tell you is that, as we've increased capacities, the marginal increase is relatively very small there because the plant is very automated. So you don't, on the manufacturing side, there is no addition of people. It's only on the packaging and handling side where you have, some proportion to the revenue that comes into the picture.
Understood. The fourth quarter, you mentioned base oil tightness. Would we be able to maintain current volumes on the oils business?
So, we don't expect the volumes to be at the 120,000 ton range. It will be lower than that. Part of it is because there has been some amount of supply chain restocking that came into the picture at the end of Q2 and in Q3. And secondly, our own sales could get impacted because of supply chain being a little bit disrupted. So it's difficult to put a exact number in place, but generally that trend is there. Like in the month of January itself, we were at a backlog of close to about 8 to 10%. So if we are not able to make it up in a quick enough period, maybe it may go to competition or that demand may actually get a bit cancelled. And the fundamental reason why the supply chain is under pressure, I had mentioned in my opening remarks, is that because of these lockdowns, the demand for fuel itself has been reduced, especially for gasoline and to some extent diesel in the Western world, which has been more affected. So as a consequence, the vacuum gas oil which comes out of the fuel refinery and is the basic feed into the lube refinery, that quantity itself is lower. So as a result, the lube refinery is not able to run at its full capacity. So that's why the supply chain has become relatively tight. We have 65% of our volumes that come on contract basis. Even the contract suppliers are running behind schedule, but they have promised that they will catch up on it before they give any spot availability, and the spot market is extremely tight right now.
Got it. And just on the cables business, we've seen a very good recovery overall. With the resumption in your sales to railways and defense, should we go back to say a 3Q20 sort of run rate by the fourth quarter or even better?
So, I don't think it will be the railway and the defense side will start picking up, but it's not going to be a step function because there are still some corona cases that come up in these places, etc. They've not yet ramped up completely, but their utilization was extremely low right up to December. and we see from January, the offtake increasing and the activity also increasing over there. So you won't see a massive step function. Where the jump is likely to happen is on the solar side, where the solar sites are all back up and running. And that being a relatively short implementation cycle, solar cable demand is pretty strong. So fourth quarter will be definitely better than third quarter of FY21. May not be as good as the third quarter of FY20. Yeah, does that answer your question?
Yes, thank you.
Oh, okay, right. Thank you.
Thank you. The next question is from the line of Sriram Rajaram from Natnatraya Capital. Please go ahead.
Do we have any plans to enter the EHV cable space?
Can you come again? I couldn't hear you very clearly. Can you come again, please?
Do you have any plans to enter the EHV cable space, extra high voltage space?
No, at this stage we don't have any plans of getting into the EHV side. We can go up to 66 kV, and that's the 66 kV for the typical cables, and we can get up to 132 kV on certain types of cables. But we don't intend to get into the EHV side. That would need a complete new investment. So that's not on the cards.
Okay. Fine. Thank you.
Thank you. The next question is from the line of Adit Shah from Vibrant Securities. Please go ahead.
Hello, sir. May I know if there is any change in the competitive positioning of the company post the removal of MEIS and the new scheme and whatever the rates are? So is there any change in the competitive positioning across the three verticals for us?
MEIS, they have withdrawn this MEIS from 1st of January, and we are informed that the full details have not come in the road tax scheme. But we are informed that the road tax scheme is not available for the companies which are taking advance license route. So we mainly go on advance license actually. People who go on the drawback rate actually, so along with drawback they will be giving this road tax, and that amount is going to be, the percentage is going to be meager actually.
Otherwise, MEIS was amounting to approximately
2%. MEIS was 2%, and we haven't got the MEIS for October, November, and December actually, because in September they said that from September to December, per SEC, maximum MEIS will be 2 crores. Whereas our conductor division, every month it accrues 2 crores of MEIS. So in September itself, we accrued that actually and accounted for in September. October, November, December, there was no MEIS for conductor as well as for cables.
And our competitiveness may not change much because the competition from the other Indian parties would also be
They will also get affected.
Yeah, they will also be in the same boat with regard to MEIS. And with regard to steel costs, internationally the steel prices have gone up. So even our competitors abroad also would be facing the same kind of cost pressures.
Okay, got it. And secondly, in terms of, do you want to hazard a guess for the guidance for next year in terms of what kind of volume growth we can see and the EBITDA per ton in across categories?
So I think, at this stage we need to actually just wait until the fine print is out in terms of the execution plan of all these initiatives announced in the budget. I mean, what seems quite clear is that there is a strong intent to execute this. Similarly, there's been change in leadership in the United States, and Mr. Biden and his government expect to be investing money in terms of infrastructure. So I think we'll probably, the next 2 months will be quite useful in terms of being able to gauge, where exactly this will stand. But the trend is very clear that as you get into 22 and 23, execution of all this will take place. Now how fast and to what extent is something that we still need to wait and watch.
Got it.
But the trend line is clearly upward.
Right. Got it. And one last bookkeeping question was, I see that employee cost in this quarter is actually lower versus even on a quarter-on-quarter basis, which seems a bit unlikely.
We have done some cost reduction actually.
So we've done cost reduction, just like most of the companies that did during the peak of the COVID period. So we've gone down and made sure that housekeeping is in place. So a lot of unnecessary costs and things like that have been scrutinized, and we've moved some of it out. There will be some increase which will come back in terms of travel, conveyance and things like that, but it will not go back to pre-COVID levels. So we've actually redone some of our cost structures to the extent where it doesn't tear the fabric of the company, but wasteful things have been brought under control. So that's how I would see some of this cost benefit actually continuing to carry forward.
Got it, sir. Thank you. That's helpful. All the best.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. Participants, to ask a question, you may press star and 1 now. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah. Thank you everyone for joining our Q3 earnings call. This pandemic is not over, and I just hope everybody remains vigilant and safe. Obviously, we are trending in the right direction. Given the fact that our budget has allocated significant amounts of money to the infrastructure spend, and we see infrastructure spend taking place across the world, with the capacities already in place, I believe that over the next few years we should see a good amount of leverage in terms of our assets as well as the geographic spread that we have, and the company clearly has a good runway ahead of it. And so we look forward to the next few years being actually better than the performance in the current years. So once again, thank you for your time, and please be safe.